What's this historical record tell us? What have small company stocks done over the last 90 plus years? Large company stocks, T-bills, government bonds, corporate bonds. So Drs. Ibbotson and Sinkfeld do a historical study and create all these charts and add a new point every year to these data. And you can see what happens graphically. You can see very clearly that small company stocks started off kind of rough, but they have grown to be the most profitable investment, are growing to something like almost $40,000 for every dollar invested in 1926. T-bills grow slowly and surely and kind of mimic inflation, and the small caps have been the best over history, and we can see that in the chapter. All the data, year-by-year data is included. Ibbotson and Sinkfeld also build these plots every year to see what the highest year was. So in your long-term government bonds, they chose a portfolio of U.S. bonds with 20 years time to maturity. And you can see in 1982, they had a very high return of 40+%. That means that interest rates were probably going down at that time. Interest rates go down, bond values go up, and the bonds tend to do well in a low interest rate environment. Small company stocks are the smallest 20% of companies on New York Stock Exchange, and in 1933 had a phenomenal gain of almost 143%. Some examples of stocks that go into these: Tootsie Roll and Tupperware. Large company stocks tend to be your large company, your Ford, your GMs, your large chemical companies, Starbucks, Walmart, largest 500 companies in the United States. And they were volatile. They have some returns, some years down below the x-axis, most years above the x-axis. Best year also 1933 with almost 54%. So somewhat volatile. And you have to ask yourself, which stocks do I want to invest in once I create my 401k, IRA, or just everyday stock portfolio? And do I just want to take and buy T-bills? This was a strategy that my father employed. He had a great difficulty seeing, so he could not invest in stocks and bonds because he couldn't read the stock charts and the quotes and see what they were doing. So he went very simply with T-bills or CDs, which tend to mimic T-bills. He luckily graduated from life in 1981 when his plant closed down and he retired, and he happened to hit it right at the peak of the T-bill history. If you see this chart, about almost 15%. And we know from session 5 that if you can get 15% on your money, you'll double your money every 5 years. Rule of 72. 72 divided by 5 is roughly 15. So you get 15%. That's what happened in 1981. And that's when my dad marched out and bought a 10-year certificate of deposit, which again mimics T-bills, at about 15%. So he doubled his investment in 5 years and then doubled it again in 10 years. Now, 10 years later, he comes out with his money and he has to do something with it. And he looks at investing it, and rates at that time were about 7.5%. So he took another 10-year CD out. No muss, no fuss. Don't need to look at it. Don't need to worry about it. It's locked in there. You just can't take it out without penalty or taxabilities. That's a disadvantage of the CD. But he was able to leave it in, live on Social Security and some long-term disability funds that he got from his employer. And boy, what an investment that was. So first 10 years at 15%, second 10 years at 7.5%. You do the math and you can see that his initial investment multiplied 8 times. So if he invested $100,000, which he had saved up for life, which really clearly wasn't enough, at the end of 10 years, it had quadrupled to $400,000, and by the end of 20 years, it had gone up 8 times. So these tended to be, for his, just lucky that he retired back in 1981 and not in 1991 or 2001 when rates were much, much lower. So T-bills in a high interest rate environment can be a reasonably good or very good investment. Investments have performed differently over time. Until the 40s, small caps were horrible. Now, small caps are the leading investment. But what does that mean? You take on higher risk. They give you a higher return, but you take on higher risk. Large company stocks used to be the best performers. T-bills, like I said, slow and steady with the exception of a few of those years. where interest rates were really, really high in the early 80s. They usually imitate inflation. Here are some bad days on some of the worst days on Wall Street. Dow Jones Industrial Average collapsed 23% on Black Monday, October 19th, 1987. And you see some other fairly bad days during the Great Depression where drops of 12, 13, 19% were common. Recently, we had a bad day on September 11th, 2001, with the September 11th attacks. Stock markets closed for 4 days. When they reopened, there was a huge drop of 687.5 points, but at that point, it only represented a 7% drop, which percentage-wise was not even in the top 10 percentage declines. So painful, but not as painful as it might have been.